The great housing crash of 2023 can finally be put to rest. We got all the way to 8% rates without the market crashing, and the worst is now behind us. This week we had a 35% increase in the number of people applying for mortgages over last week, but that's not seasonally adjusted data, so we'll get to that in a minute. Housing supply will continue declining for the rest of the year and likely all the way until the spring market, and demand is likely going to pause as people disconnect for the holidays. There was a viral article going around this week claiming that 44% of homes sold this year were all sold to institutional investors. Absolutely not. If you've been waiting all year for this price crash that the media has been talking about to happen so that you can now buy a house, that ship has sailed. Your next best opportunity is going to be to buy between now and January when prices and demand are seasonally at their lowest. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties. We're looking at trends, we're tracking mortgage rates, as well as mortgage applications, as that's our best leading indicator to what demand is going to look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part. It's the top 10 ranked charts of the hottest and coolest both cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy a home in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is December 11th. Let's see what the data is telling us, and if this is an old video, you can click the playlist here and it'll take you to the latest weekly market update. Okay, first up is market news. The main thing I want to cover today is this idea that home prices are too high because institutional investors are buying up all of the housing supply. I've seen articles like this circulating all year long, and this one is claiming that 44% of the homes sold this year went to institutional buyers. So this is the perfect time to shed some light on the reality of the situation. Now, this article is so far off, it is very hard to believe that this wasn't done intentionally, but maybe someone just made a really big, honest mistake. But here's the first chart I want you to look at. This chart, as you can see here, is directly from Freddie Mac Economics and Housing Research, the government agency, and this number includes both institutional investors as well as iBuyers. This is companies like Open Door that say that they'll buy your house from you at what they say is a fair rate in exchange for you using their agents to buy your next home. So if you look at this number, all of the homes purchased by both institutions and iBuyers is less than 2.5% of the homes sold. Less than 2.5%. How you could get to 44%, I have no idea. Now, this article did say specifically institutional investors, but for full context, I want to show you a number that's at least a little bit closer to this that you may not have been aware of. This is the overall investor share of purchase market, and this is also from Freddie Mac Housing Research. So you may not have normally known that about 25% of homes, if we look here at the median, always sell to investors. Every single year. But as we just saw, institutional investors on the high end only account for about 2.5% of these sales, including iBuyers. The vast majority of these buyers in this 25%-ish category are just people like you and me who want to buy a rental property. But what I want you to see is this number is still within a totally normal range. It's at the higher end of the range. It's around 30, but as you can see, that's totally normal. That is within the normal swings of the year. And this share of the market has always gone to investors. This is not something new, and this is not hedge funds. And we can see this further supported on this next chart. And this one is only going up through Q2 of this year, but you can actually see that institutional investors, actual institutional with 1,000 plus properties, this is like BlackRock, who everyone's always coming after, it did get as high as 2.4% in Q2 of 22, but it's been dropping ever since, and it's dropped from last year to this year from 2.4 down to 0.4%. Another helpful chart here, you can see that the majority of sales, 19.6% of them, go to these tier 1 investors, which is just regular people, 1 to 9 properties. 19.6% of investments go to them. Tier 2 is 10 to 99, that's 2.7%. And then as we get higher up, iBuyers is 0.5, and the tier 4 investors, 1,000 plus properties, is only 0.3% as of Q2. So these are the BlackRocks, the people that you're thinking are buying up all the supply, driving up prices. It's just not happening. And last but not least, I just want to show you the home ownership rate. This is straight from the Census Bureau, and this is all the way data through Q3 of 23. So right here, this 66% line, that's exactly where we are right now. This is the percentage of homes that are occupied by people who own them. And what this also tells you is that 34% of homes are rentals, and a strong rental market is vital to a healthy city economy. So we're right now, 66% of homes are owned by the person who lives in it. And if you look, starting back to 1965, we were as low as about 63%. Way up here, around 2005, we got up to 69%. After 2015, we got as low as about 63% again. So that's the bottom of the range. And right now, we're dead in the middle of the range at 66%. So we have a totally normal market, a totally normal number of people owning homes. So if you're looking at someone to blame for home prices going up and there being no inventory, this would actually be millennials who started buying in 2013, and up until rates jumped in 2022, they were the largest segment of people buying homes. And since then in 2022, it's been Gen X and baby boomers who are buying all the homes. But either way, it's simply not Wall Street. There is just no evidence of that. There is no foul play happening here. No further legislation is needed to stop these evil corporations. It's not happening. This is a free market functioning as intended. People need rentals. Some people buy rentals and put them on the market. A rental market is totally part of a normal market. Some people have more money. They want to buy their first rental. That's totally normal in this economy. So there is no foul play here. This is a free market functioning as intended. The hedge funds are simply not ruining your life. Okay, moving on. If you're considering buying a home anytime soon, within the next year, two things. Number one, I'm putting together an online first-time home buyer seminar, and I plan to do the first one in January. If that's something you're interested in, leave a comment below. I've never done one of these, but I hope to do them regularly, basically for anyone who is even considering buying a home within the next year in the DFW market. Number two, I've developed a max affordability calculator. This will help you very quickly and easily get into the ballpark of how much home you could afford today with today's rates and your personal financial situation. It will give you several different options to review, and it takes into account everything all the way down to your income tax bracket. I've had dozens of you reach out to me already saying how helpful this was for you, and I'm so glad to hear that. This is completely free to you, so take advantage of it. And if you're interested in this, you can watch this video here next. It walks you through how to use the calculator. Okay, moving on. Here we're looking at national housing inventory. This is number of homes for sale in the US. And I also want to say, you may see other numbers like NAR puts out a number that would say we're over 1 million homes for sale. But that data doesn't make any sense because that includes homes that are already pending and under contract. Well, you can't buy a home that's already under contract. So that's why I use this data from Altos Research, because they exclude everything that's under contract. And if it falls out of contract, then it comes back into this active inventory chart. But this week we had a decrease of 9,293 homes for sale in the US. Again, this number will continue dropping, all the way into likely the spring market. Now let's look at new listings. We had our big drop as expected last week. We had our big jump as expected this week. All you need to see is we're right back on track with where we were in 21 and 22. It's good because it means we're not below that. So ideally, eventually, this is going to start trending higher and we're going to get back to a normal market. But for now, we've stopped dropping. That's the good news. We're within a normal range. And I say normal for the last 2 years, not normal for anything before the last 2 years. And the last thing we want to cover is the number of homes having price decreases. And this is an important one because if there were any housing crash coming at any point, you would have seen it reflected here. So what this means is currently 38% of homes are having price decreases this week, whereas last year, same week, 42% of homes were having price decreases. And we have consistently been 4% less homes having price decreases compared to last year. So again, if there were a market crash coming, we would certainly be seeing more homes this year having price decreases. We're seeing less. And we'll look at all of these numbers in the local markets here in a minute. Okay, moving on to mortgage rates. Let's see, we started last week at a 7.11, got all the way down to 7.04, and then ended Friday at a 7.09. But the point is, we are very close to 7, and well, let's look at the 10-year real quick and I'll explain what I'm thinking. Okay, looking at the 10-year, you see the jump that we had on Friday. You see we're trying to climb a little higher today. We'll see where that ends up, but it wouldn't be unusual to get back to this black line. We did have a little channel there before we broke out. But the point I want to make is the spreads have gotten worse this year. What that means is the spread between the 2 and the 10-year. So basically what we know is when the 10-year rate is going up, mortgage rates are going up. But it's not an exact math as to how much because the spreads are very important. The spreads between the 2 and 10-year determine how big of a gap. So for example, the 10-year is at 4.28, yet mortgage rates are above 7%. So that's almost a 3% difference. That number is not usually a 3% difference. It's usually much closer to, let's say, a 2% difference. And the spreads got really bad. You'll remember at the beginning of the year when all of the banks were going to collapse and we were running out of money and we weren't going to be able to withdraw and all that whole banking crisis, spreads got much worse. So what I want to show you is back here in January, this candle closed up here and that was a 5.99. As you can see, several times after that, we closed even lower than where the 10-year was, yet rates never got back to 5.99 because the spreads were now worse. So what I'm trying to say here is right now, we're around, let's say, a 7.1 here. Well, we could stay right there, and if the only thing that happens is spreads get better because there's more faith coming into the market and more stability in the bond markets, then we could remain right here. Today it could be a 7.1, and over time, even though the 10-year won't be dropping, we could easily get down to 6.5% mortgage rates just from the spreads getting better. So the only point I'm trying to make is don't think that this number needs to get all the way back down here before we see 6% rates. We don't. It could come down just a little bit, and the spreads get a little better, and we're back at 6%. Okay, now moving on to mortgage purchase applications. As I said, we saw a 35% increase in the number of people applying for mortgages week over week. And at face value, that seems like a huge number, but when adjusted seasonally, it actually was a totally neutral print from last year. And I personally care more about the seasonally adjusted data. So it's not nothing that we had a huge jump week over week. That shows that rates dropping is bringing in demand. But when we look seasonally adjusted, we're exactly where we were a year ago. And this makes for 22 positive, 23 negative, and 2 completely neutral prints for mortgage purchase applications this year. Now I'm going to quickly run through the MLS data, and I want to say all of the data around holidays always gets weird. Now I'm still going to report it because what else am I going to do? But just know, usually within 2 weeks of holidays, things just get weird. So take this with a grain of salt. Starting with Dallas County, we had 228 closed sales. That's 58 less than last week. 238 went under contract, 13 more than last week. 386 listed, that's 36 less than last week. Of the homes that closed, 44 were immediate sales, meaning they contracted within the first week. That's 36 less than the previous week. And in total, there are 1,784 homes either under contract or in pending status. That's 21 more than last week. Looking at Collin County, we had 178 closed. That's 53 less than last week. 151 went under contract. That's 35 more than last week. 253 new listings, 8 less than last week. 23 immediate sales, 20 less than last week. And in total, 1,406 homes are either under contract or pending status. That's 43 more than last week. So what clearly stands out to me here is less homes are being listed and more homes are going under contract. The number of sales that happened, I care less about because that's lagging data. That reflects what the market looked like a month ago. Right now, what the market is looking like is more people are contracting and less houses are being listed. Okay, let's move on to housing data. Okay, starting with Dallas County, you'll know if you watch my videos, I use the Market Action Index. It takes all of this info, puts it into one easy to read graphic with a number. Anything a 30 or below is a buyer's market. Anything above a 30, we're asking how much of a seller's market are we in. Currently, we are at a 42, which is a slight seller's advantage. No surprise here at all. What's happening is median list price is going to continue to drop. And of course, this is all of the homes that have been sitting that nobody wants are going to continue cutting as fast as they can, trying to make a sale. The median price of new listings took a small uptick this week. The number of homes having price decreases, though, is starting to decline from 46. We're going to zoom in on this in a minute. Inventory obviously is declining. That's normal this time of year. So nothing unusual at all, and let's see, yeah, pretty much flat for the Market Action Index. But I wanted to see the number of homes having price decreases on the 7-day. So this week, a year ago, there were 46.47, and now there are 44.49. So 2% less homes having price decreases this week versus last year. Now let's move on to Collin County, exact same thing. They're at a slight seller's advantage as well at a 43, and they actually had a small uptick this week in their Market Action Index. 42.86 up to 43.25. Their median list price, pretty steady. Small changes over the last few weeks, but new listings are getting higher. Median days on market remains at 49. The number of homes having price decreases as well is dropping. Their inventory looks to be dropping quicker than Dallas, so we'll zoom in on that in a minute. And again, their Market Action Index, small tick up, but starting with inventory, let's see. So there is a little bit more inventory than there was a year ago, 1801 to 2013. So basically, July 21, we have the same inventory as we did in July. So this actually looks pretty consistent with last year. You barely got more supply in the spring and summer market. So I would expect these numbers to get probably back down here where there's maybe 1,200 homes for sale all the way through March. Now just zooming into the number of homes having price decreases. Last year, we were at a 55.19. We're well below that this year at a 45.65. So all that this data is showing us every single week is that there is no market crash coming. I don't know how else to say it. Like, there's just not data to support that. Okay, now we're moving on to my favorite part of the video. This is the top 10 ranked hottest and coolest, both cities and zip codes in all of Dallas County. and this is using that same market action index number we just used. Okay, starting with the absolute hottest cities, Carrollton remains at number 1, Coppell at number 2, Louisville, Duncanville, those all remain in their spots. But Plano heats up 3, Sachse cools off 1, Prosper cools off 1, Irving cools off 1, Garland heats up 1, and Mesquite jumps onto the number 10 spot, knocking Richardson from number 9 to completely off the list. Now we like to zoom into specific zip codes. Keep in mind a 30 or below is a buyer's market, so these zip codes up in the 50s and 60s are still very hot sellers markets. So starting with the absolute hottest, it's Irving 75063, Carrollton 75010, Duncanville 75116, Louisville 75077, Coppell 75019, Carrollton 75007, Dallas 75249, Garland 75042, Louisville 75067, and Dallas 75287. So these are the absolute hottest cities and zip codes in all of Dallas County. Now let's do the same thing for the coolest markets. This week, Leonard falls back into the number 1 coolest market, and it is the only buyer's market left. Last week, Ferris was a buyer's market. As you can see, it's over 30, so it's no longer. But Leonard cools off 1, so Ferris heats up 1. Whitewright, Van Alstyne, Seagoville, and Salina remain in their spots. Farmersville cools off 1, Rockwall heats up 1, Nevada jumps onto the list, and Royce City remains at the number 10 spot, so Sunnyvale heated from number 9 all the way off the list, and in its place is Nevada. Looking at the coolest zip codes, we have Leonard 75452, followed by Dallas 75212, Ferris 75125, Whitewright 75491, Dallas 75220, Van Alstyne 75495, Rockwall 75032, Dallas 75203, Seagoville 75159, and Dallas 75205. That's it for this week's video. Thank you all for watching, and as always, if you're looking to buy or sell in the Dallas area, just call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.